Welcome to the Market Report. Today's September 15th, 2023. For the past 45 years, China has been speedrunning their economy, with real GDP growth averaging near 10% from 1979 until recently, allowing them to go from the 8th largest economy to the 2nd largest economy today. Unfortunately, the country is currently facing a whole host of economic problems, which may spell an end to their insane run. It seems like nowadays, every time I check Bloomberg or the Wall Street Journal, the song 99 Problems by Jay-Z keeps popping up for anything China related. And the worst part is that unlike Jay-Z, even the bitch is looking like a problem. At first, I was skeptical of these articles as I assumed it was just another one of these PSYOP campaigns created by the Western media propaganda machine to try to spread FUD and paint China in a bad image. But the more I looked into it, the more it seemed like there may be some basis towards their claims. So in today's video, I'll be doing a quick summary on China's current economic situation, and we'll start by looking at the macro indicators. Official GDP numbers for China this year is 5.5% year-over-year growth for the first half of 2023, with Barclays forecasting full-year GDP growth at 4.5%. 4.5% GDP growth is actually considered really good for a developed economy, in comparison to the growth rate of other top economies. But if you take a look at China's GDP growth rate for the past 20 years, it has been on a steady decline, which is the cause for concern. In addition, the base GDP numbers for last year was low, as many cities were still facing lockdowns, including Shanghai, which is the largest GDP contributor for the country, meaning there should have been a much higher increase in this year's GDP numbers, which is not the case. Now, you can make the argument that since their economy has matured to become the 2nd largest economy in the world, the eventual decline in growth rate is natural, due to diminishing returns. And while that may be true, if we take a closer look under the hood, we may find that a lot of the economic growth is not as it seems. But don't take my word for it, as this was a statement made by the ex-premier Li Keqiang. The most recent data released regarding inflation showed that China experienced deflation year-over-year in July, for the first time since February 2021, as CPI decreased by 0.3% and producer price decreased by 4.4%, marking its 10th straight consecutive month of declines. Now, although the media may have brainwashed you to believe that deflation automatically equals recession, don't believe in everything the media tells you, as deflation can actually be a good thing. It can happen as a result of improvements in the supply chain process, such as technological advancements in machinery which improves production capabilities, leading to increases in the supply output and decrease in prices. Unfortunately, this wasn't the case and it's looking like a recession, as this deflation was demand-induced. Overall unemployment rose to 5.3% in July, with youth unemployment reaching a record high of 21.3%. The number had gotten so high to the point where the government decided to suspend data in regards to the unemployment numbers, citing problems with the way data is collected. On top of the concerning macro indicators, the Chinese government has also been adding fuel to the fire through policies and actions that show its priority towards national security over economic growth. Ever since the first major crackdown on Jack Ma's $37 billion Ant Group IPO in 2020, many other tech companies and industries have also been getting clamped down, including private education, gaming, real estate, and now healthcare. Between the tech and the other sectors, a total of $1.5 trillion in stock value was completely wiped at its peak. This level of government oversight has led to companies calling China uninvestable, as foreign investments is believed to have fallen to a 25-year low, with net foreign direct investments being negative for 4 consecutive quarters. Along with the crackdowns, China's current trade position isn't looking too good either. Increased tensions with its main trading partner, as well as global trends looking to de-risk from supply chain constraints seen during COVID, are hurting China's export and industrial sector, which accounts for roughly 30% of their GDP. Data shows July exports decreasing by 14.5% year-over-year, which is the largest decline in 3 years, with August continuing the slump. Now, moving on.
Let's go ahead and get into our main man, the champion himself. No need for introduction.
The situation with the Chinese real estate market has been the biggest source for China's current economic problems. This is due to the fact that over the past 20 years, the housing boom has been one of the main drivers for its insane GDP growth, with an estimated 24% contribution to their total GDP, taking into account the related sectors. With the total estimated housing market size to be about 62 trillion, which is 15 trillion bigger than the US's size. The current problems are deeply rooted in the mechanisms in which it achieved such growth, as a large part of it was fueled by massive amounts of debt, as well as their pre-sale housing system, where developers sold housing units before construction on those houses even completed. Couple that with provincial governments pushing a growth-at-all-cost approach, this eventually led to a lot of oversupply, with the infamous ghost cities popping up in many second-tier cities. As stated in a New York Times article, governments pursued the motto, advance eastward, extend southward, expand westward, integrate northward, and prosper in the middle. Now, I don't know about you guys, but to me this sounds like something Genghis Khan was saying back when he was trying to conquer all of Asia, with the difference here being that you replace the army of soldiers with an army of construction workers. And the mission? To conquer empty plots of urban land. I mean, it's no wonder there's an oversupply of houses when this is what they're saying. Nevertheless, this model of growth was working well up until 2020, when the government decided to step in and limit the amount of leverage allowed to be taken on by the real estate developers through its 3 red line policy. However, at this point, many of the largest real estate developers had already taken on too much debt, with not enough revenue coming in due to the slump in housing sales. This eventually led to China's second largest property developer Evergrande to default on their debt obligations and formally declare bankruptcy on August 17th. Many other real estate developers have also followed suit, with one of China's biggest property developers, Country Garden, just narrowly avoiding default on their recent dollar bond payments. Now, fears of widespread contagion have been the top concern, as a company called Zhongrong, a subsidiary of Zhongzhi Enterprise Group, which is part of the 2.9 trillion trust industry, has missed payments on some of their financial products that they sold to investors. These shadow banking companies are closely tied to the real estate sector, as many of them have financed developers through investments in bonds, stocks, and other related assets. Others that are largely affected include painters, cement makers, builders, and real estate agents that together are owed $390 billion in payments, according to Gavical Research. Data collected by the China Family Panel Studies showed that housing assets accounted for 85.8% of the total share of Chinese household assets in 2018. To show how high this is, home equity only made up about 28.5% of US household wealth. Therefore, a full-blown real estate crisis would be catastrophic for households across the country, especially for those with money tied up in unfinished apartments that may never be completed, as they will feel the pain that cum-rocket hodlers have been experiencing for the past 2 years. To conclude, consumption has been weak due to a large portion of household wealth being tied to a declining property market, as well as high levels of unemployment, which has caused deflation. Investments have been declining due to the government's priorities of national security over economic growth, which has led to large declines in foreign investments. Exports have decreased the most in 3 years, with the overall trend of countries continuing to decouple from Chinese supply chains. The only thing that can save the economy currently is if Jim Cramer announces he's bearish on China, and then we'll know for sure. It's time to leverage to the tits and go all in on Chinese equities. This has been the Market Report. Thank you guys for watching.